Hey folks, good afternoon. I'm sorry it's taken me so long to get these videos to you. I wanted to talk to you real briefly about the decisions and reports that you're going to see in Globus because I mentioned this to you in class today, but you've really got three sets of reports available to you. The first is the Cameron Drawn Journal. In that you've got 8 pages. The first page is going to be your scoreboard. Okay. You're scored on 5 different specific things. I'm going to run through each of those quick with you, and then I'll share about the rest of it. Okay. So the scoreboard gives you your game to date, and then it gives you your current year scoreboard. The current year is up top. Game to date is here. There's 2 components to each of your scores. There's investors' expectations, and then there's best in industry. And they do a weighted average for those. They combine those, okay? Investors' expectations is the extent to which you exceed the investors' expectations or meet them or don't meet them. And the best in industry is simply a ranking. The higher you are in the industry, the more points that you earn. The weighted average is the combination of those. And you can earn bonus points for a couple of different things. I'll talk with you about that on page 3, okay? So the first factor you're scored on is your earnings per share. Across the top, you'll see your investors' expectations for each of the years that we'll run the simulation. We'll probably cut off the simulation at year 13, which means that by the end of the simulation, the investors' expectations will be $10.50 per share. In the current year, the investors' expectations are $1.25. Historically, you've made 75 cents per share. So you can see the investors' expectations go up every year. Return on equity, historically, you made about a 15% ROE. Current year's expectation is 17.5%, then goes up to 20%. By the end of year 13, it's 45%. You see stock price is the third quantitative score. The investor's expectations is that your stock price is going to increase from $12 a share to $20 a share, then 35, and then by the end of year 13, you should be trading at about $300 per share. Now, earnings per share, really straightforward. It is simply your net profit divided by the total number of shares outstanding. Return on equity is your return on average equity. It's your net profit divided by your beginning equity plus your ending equity divided by 2. So it's return on the average equity. And the stock price is a little bit of a black box. When I say black box, what I mean is there's something happening inside the box that is kind of proprietary, right? They're not going to tell you exactly how that stock price is calculated, but there are some very specific things that you can do to increase your stock price. There are some very specific things that you can do to make your stock price go down. So those are the first 3 quantitative things. Up next is your credit rating. Your credit rating is based upon 3 things. Your credit rating is based on your finance and cash flow screen, is your debt to equity percentage, your interest coverage ratio, and your current ratio. Together, those things are calculated to determine what your credit rating is. Investors' expectations for year 6 and 7 is that you'll have a B+, and by the end of year 13, you're expected to have an A credit rating. Your image rating is also somewhat of a black box, but the question's already been answered, folks. The way that you can increase your image rating other than getting market share is by putting money into corporate social responsibility. As you see in year 6, the investor's expectation is 70. By the end of year 13, the investor's expectation is an image rating of 80. Okay? So corporate social responsibility and citizenship, this will tell you how much the industry on average is spending on CSR. And starting in year 9, there will be an award for the company that is the most corporately social responsible. Okay, corporate responsibility. Be careful with that award, because I could make an argument that that award is simply the award for giving away the most money. And you don't want to give away the most money. There needs to be a method to the madness, a method or a reason that you're giving away your investors' hard-earned money. Okay. Page 3B, I don't know why they name it, why they put it page 3 and page 3B. It should be page 3 and 4, but just work with me here. You can win bonus points for a Bullseye Award, which means that you're plus or minus 5% in your revenues, plus or minus 5% in your EPS, plus or minus 4 points in your image rating. Okay, for every year that you meet those criteria, you can win a Bullseye Award. You can also win a Leapfrog Award for having the most year-over-year improvement. Okay, now you're not going to earn a Leapfrog Award from year 5 to year 6, but if you have the most improvement in your overall score in years 7, 8, 9, you'll win that Leapfrog Award, and you can win multiple of those. Okay, those are bonus points, and they show up on the game to date scoreboard. All right. Page 4 of the report is the industry overview. As things start to fill out, you will see the graph being built. Right now, everybody's selling their camera for $225. Everybody has the same 10% market share. It tells you what demand is. It's expected to increase 7% in year 6. And it was up by 7% in year 5 from year 4. It's also expected to increase by 7% in year 6. And then drone statistics, you'll see average selling price is $1,075. Drone demand was equal to forecast. It was up by 18.4% from year 4, and it's expected to increase in year 6 by about 18.4%. So pretty robust growth in that industry, right? Page 5 is comparative financial statements for all of the companies. So all 10 companies right now have their income statements, balance sheets, and financial and operating statistics. Those are shown for every company. You'll see the calculations, for example, on what your net profit is. You'll see the calculations, for example, on what your ending equity is. I'll go over this stuff in much better detail for you as we get into the semester. You can see how much the dividend that your competitors are paying is. You'll see what the total dividend payout, the payout ratio. You'll see everybody's debt to equity ratio, interest coverage ratio, and total number of shares of stock outstanding. Okay. The last 2 pages are the benchmarks for your action capture camera and your UAV drone. This tells you what the industry is doing on average. So the first column is going to be what the lowest cost producer on the camera or the drone is doing. You can see what the lowest cost is. The second column is the average for the industry. The third column is the highest in the industry. And then the last column is specifically your company. So since we have 10 companies that are producing exactly the same product, the low, the high, the average, and your company are all the same. The bottom of that shows the geographic operating benchmarks, and it tells you what your delivery cost, your marketing cost, your operating profit margin, your warranty claim rate, your repair costs are for each of your 4 geographic markets. And then page 7, really page 8, shows you the same information for your UAV drone. So you'll see the average cost to produce it is $806.22. You'll see the average company has 100 workstations installed. You'll see how much the average operating profit margins are for everyone and the warranty claim rates and all of that, okay? So that's going to wrap it up for this video. I've covered the camera and drone journal and given you a little insight so that when you take a look at the results tomorrow morning, you'll see how you did and you'll have some context for that. Thanks for watching.